And welcome back to the Building a Retirement Plan That Lasts podcast with your host, Gary Bowman. Gary, you're sailing along here. We're on the third episode already of your podcast. Congratulations.
Well, thank you. Yeah, we're cruising right along.
I know,
Feels
man.
good.
We're like, boom, we're on the highway and we got the top down and we're moving and it's not, I say it a little facetiously, but it's not a joke. A lot of people don't make it past their second podcast. And a whole lot of people don't make it past their fourth podcast. So we're in 3.
Wow.
And we're ready to move here. You know?
That's good news.
Today, you want to talk about sustaining yourself in retirement. And of course, by sustaining yourself in retirement, really, we're going to have to talk about a practical aspect, which is creating a sustainable paycheck in retirement. How do you go about that? And why is the shift from saving and accumulating and getting ready for it way more emotional than it is mathematically, it seems, for most people?
Oh, it's a big transition. I've done it with many people.
Yeah.
And when you're working and you're accumulating, it's just a systematic thing going out of your paycheck, right? Your funds are going into your 401k, and they're pretty much a certain percentage are going to certain things. So it's already all pretty much done for you. You're like on autopilot. So you're cruising along. If the market happens to pull back, you're like, well, I'm still working, and it usually comes back, and I'll just keep plugging money into it, and it's going to be fine, right? So you're not as emotional then, but that transition, it's stressful to go from, what am I going to do now? Now I have to create my own paycheck. And so it's that's why you have to do the plan. That's why you have to work it, because the income that we start to look at, first of all, before you retire, is what are your guaranteed income streams? What things are you going to be coming in, like Social Security, your pensions, things like that. So when you make that transition, you have confidence that those are going to be there for you. So you have a good plan with your budgeting, right? So you have a budget. This is what it costs to live. Here's my guaranteed income streams that are going to be steady, reliable, are going to get some cost of living adjustment with Social Security. And then you have your personal assets that you're investing. And now you're like, I sure hope I have enough that I will be able to live the rest of my life living the lifestyle I want to live.
Right.
And so that transition, it's stressful because you're having to rely on your own decisions and your money and the beliefs that you've made the right decisions.
Well, yeah. It's a weird moment when you are not collecting a paycheck from somebody else, isn't it? I mean, it's one thing when you're like, I'm working for Gary and Gary's paying me to work for him. It's another thing when it's suddenly I'm working for nobody and I'm paying me.
Right. Well, that is the scary part, because most people that work for an employer and have worked for a long time, they've always been paid by someone else. They never had to do it themselves. So that's a very emotional thing. So the way I look at it is, you've saved a lot of money for a very extended period of time. You've got the discipline, you've done your budget properly, you've got those guaranteed income sources. And then you look at, what do I have? And then you build income. You have that pile of money that you've saved. Now is going to work for you. So you're actually now you're the boss, and your money's working for you. So you go, hey, money, go make me some money, right?
Go make me some money.
So that's how it works. So you get the way I build a plan is, I want to make sure that we've done the budget properly, that our income sources are meeting all the needs that we need to live our lifestyle. So our interest and our dividends are covering. So when we start to pay ourselves, we're not touching our principal. We're just using the interest and dividends. Then that creates a paycheck that, like we've talked about, steady, reliable, covers the cost of our living, and it makes, once you see it and it gives you confidence, and it takes away some of that anxiety, and so you can live the lifestyle you want. You can go do what you need to do.
Well, how do you manage withdrawals, Gary? I mean, it seems to me that it's like it could be very easy to over withdraw. I could try to think of a better way to do it, but you just basically it seems pretty easy once you retire to sort of let your spending maybe slip out of your control a little bit? And how do you manage that?
Well, it can spit out of control because the time now that you're not working, you're doing things that you want to do, and that's where the budgeting comes in, right?
Yeah.
So if you haven't, say you take up golf, well, that can be expensive, and you were working, you didn't golf very much because you were working. So
Right.
now you can get in a position where the spending becomes a problem. But if we identify those things ahead of time, like here's our accumulation plan, here's our distribution plan. The budget's going to be different, the costs are going to be different. And so we have to plan for that ahead of time so that it's not something that blindsides you, that you're like, oh my God, I spent too much or I don't have enough. So we got to look at the future as we plan.
Do you work with your clients and maybe create a little room in that budget? Like just stay with the golf example. You've got a client, they're going to retire and they're already a member of a golf club. They already play probably around a week on a weekend. And now they're saying, well, now I've got time to play 3 rounds a week. I
Yeah.
mean, do you sort of work with them and say, look, why don't you budget for 5 rounds of golf, just 4 rounds, 5 rounds, so that you've got some cushion in there, and you could do that if you wanted to, but you probably are going to end up playing maybe three.
Well, yeah, you do. You definitely plan for you don't want to underestimate your budget. And this is
Yeah.
a big thing that a lot of people do this, right?
Hmm.
So you ask them, what's it cost to live every month? They're like, oh, I can live on like 3 grand a month without a problem. And you say, really? Well, let's put this on paper. So you go through everything and then they'll go, oh, my utilities are this, my car payment's that, my insurance. Then you're like, well, let's look at your credit card statements. Let's see what you've been spending over the last couple of months on those. You're like, oh, well, you bought clothes, you went out to dinner. Are you including these things in your budget? And
Mm.
most people, they underestimate budgets. So you have to put them in writing and you have to look at all the little things that might be there. So back to the golf thing is, yes, if they're like, I'm going to probably want to play 3 rounds of golf, and you're like, well, that's going to cost X amount of dollars. And so let's put a little bit of buffer on top of that.
I got you.
So it's last thing you want to do is start to overspend and start taking out more money than you can afford or what your portfolio is
Yeah.
producing. Back to the subject of, I like to say, like, this is what your portfolio is producing. This is what you should be able to live within these means. And most people that have had a paycheck for a long time and have saved are disciplined and live within their means pretty well.
Yeah.
There's just that adjustment we have to make, that there could be a little bit higher expenses in the retirement.
You mentioned portfolio. It's interesting when you have stock downturns and you're working. You sort of like, as you said earlier in the podcast, you tend to dismiss it. You figure, okay, fine. And I got time. I'm not worried about it. But it's really different when markets down go take a turn for the worse when you're in retirement. Um, how do you manage that? I mean, and can is this a permanent kind of thing? I mean, retirees I think are much more sensitive to market movements than perhaps they thought they were going to be when they weren't retired.
Absolutely. They are way more emotional about their money when they see it go down, when they're not working anymore and they're living off of it, right?
Yeah.
They're not going to be able to continue to add to it. And savers like to see their money grow. They like to look at their money. And so
Yeah.
if you design, like I was talking about, you design the plan so that the interest and dividends that you are using to live on. So the money's working for you and you're pulling off what it's doing. So what it's producing, you're using to live on. A good example is like a real estate investor might have a house and they own it, usually in retirement. They probably already own it outright. And so that's just a good producer, a steady, reliable income for them. They might charge a couple $1,000s a month. And so the same thing with the type of investments that we're talking about. The market goes down in real estate. You don't go and sell your house because it's down,
No.
right? So you have different segments of your portfolio. Part of it would be is the one that's producing the income through dividends and stocks or bonds interest. Then another part would be more the long-term assets that would be more susceptible to market downturns, but that's longer-term money. And over time, you hope that is going to grow and appreciate, while the other is more moderate and is there for a specific reason, which is to produce income to pay you a paycheck.
Yeah, but it's a different kettle of fish, really and truly. When you're, suddenly you're like, wait, wait a minute, and it is really hard to dismiss it, And you are talking about streams of income here, so we can't not talk about all of this without talking about Social Security. You think Social Security decisions should be made in concert with all the other streams, as opposed to looking at Social Security separately, right?
Absolutely. When we look at them, we run separate scenarios because Social Security has a lot of different options that you can do, like when you can take it at 62, or you can take it at full retirement age, or at 70, and there's different amounts and how they calculate things. And it also, when you're looking at the comprehensive plan, your Social Security decisions can affect your spouse. So
Yeah.
that's super important, especially, if you were to pass away or something like that, the collection decisions. It could also affect your taxes. So if you're still working and you decide to take it early, there could be tax complications and implications that would arise. So you got to look at the different scenarios. Sometimes we'll use, when we run them, we'll say we'll take it at 62, and then we'll run another scenario that says we'll take it at full retirement and see how that affects the plan. Does it improve the overall net worth and the cash flow early, or better when it's later? And so you have to run the different scenarios in coordination with the whole plan, for sure.
Yeah, no, 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 no. And I don't think a lot of people understand, because they don't really think about Social Security very much until, like, suddenly they're right upon it and they're thinking, oh, it's time. I don't think they realize there's a big difference between taking Social Security, say, at 63, and if their full retirement age is 67, there's a big difference there.
Yeah, they give you, if you take it at the earliest you can take it, there's like an 8% increase that the government gives you each year.
Yeah.
So it's and then you got to remember that number is the baseline, that when they start to you get a cost of living adjustment every year. So there's a big difference in the total amount each year. So it does come down to what the need is. I mean, if you need it, then you probably would take it early. But if you don't, you might put it off until your full retirement age to get your full benefit. And it's, the break even, I think, somewhere around 12 years, but it comes down to running the scenarios and what makes the most sense in the long run for the client.
No, that makes total sense. So let's talk about balance here as we wrap up this particular episode. How do you balance stability and growth? Because I know that nobody doesn't want their portfolio to grow, right? So you got to create some kind of growth, but a lot of people have a lot less risk tolerance in retirement, and they would like some stability. So it seems like there might be a little bit at odds here in terms of that stability and that growth sort of impulse, those two impulses.
Right. Well, you have to have the balance, because the growth part is what keeps your the ability to keep up with inflation. You got to have that hedge, and so you can. There's a couple ways to do it. I mean, if you're super conservative, you can make sure you saved enough money so that you don't use all the interest and dividends that are being or that are being produced by your investments, so you can save some of those. So if you're super conservative, that's one way to do it. The other way is to trust that the markets are strong, and we have a great economy here in the United States, and that these companies that you're investing in are good, solid companies. So by balancing it through first deciding how much you need the portfolio to produce to live your lifestyle for now and into the future. So you put money over to that side, and then you can use the rest of the portfolio as growth. And there are ways that growth and income. So you have companies that pay dividends that will also grow for you over time. And so there's a lot of different asset classes out there. Some of the things that I use have both an income and a growth component to them, and so it's just it's just finding the right mix that goes with the risk tolerance of the client and fits in with how they're feeling. Because the last thing you want to do is have a portfolio that's not balanced, that is too much growth, and people get nervous and they sell out in the wrong time. They buy high, sell low kind of thing, you want to avoid that.
Yeah, no, we want to avoid that. As a matter of fact, I was going to ask you where dividends fit in this, because I think for a lot of people that like dividends can create a balance, because a stock price can go up and down on a particular stock, but dividend payments tend to remain relatively stable, don't they?
They do for the most part. It depends on the company themselves. I mean, There's a lot of companies, what they call the aristocrats, that have paid dividends for several years, every quarter for year after year after year, and have increased the dividends. But it's not always a guarantee. Companies can cut their dividends, but that's our job to watch these companies and being the ones that are more solid. They have good cash flow and profits, and so it's probably for the way I design portfolios, dividend paying stocks are very, very important part of it, because we are looking for that balance with the growth in income. And then on the other side is a little more conservative or moderate, where it's that not guaranteed, but it's the steady, reliable income that's coming in from like bonds or CDs, government bonds, stuff like that. So you want to build a portfolio that has some of that steady income that's going to be there no matter what. The market goes down, you still have the same income coming in. It doesn't change. So that's super important. But you do want to be able to be capturing the upside of the market, at least on part of your portfolio when the markets are good, which is a important part of the portfolio.
I would
strategy.
Absolutely. That is true. If there's anybody who's listening to this and this conversation is striking a chord with them, Gary, and they're not a client of yours already, should they reach out to you? And if they should, what is the best way for them to get a hold of you?
The best way to get a hold is probably just go to my website, which is bowmanretirementplanning.com. And then just go around, look at the site, and then there'll be some ways to get a hold of me from on the site.
Yeah, reach out. And I will say this over and over again, and if you listen to the podcast, you're going to get tired of hearing it, but it costs you nothing to call Gary. It's free, and it could be a conversation that leads to a little bit better financial outlook for yourself. So do it. The other thing you can do is you can hit the follow button to become a subscriber. Like it, let people know that you find this podcast interesting and useful. Beauty of being a subscriber is you won't ever miss another episode. It's your choice, because you'll be notified and you can give it a listen. Until next time, I'm Bill Tucker on behalf of Gary and everybody at Bowman Financial. Thanks for taking the time to listen today.
Thank you for listening to Building a Retirement Plan That Lasts. If you enjoyed this episode, click the follow button so you can be notified when new episodes are released. To learn more, visit our website at bowmanretirementplanning.com. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Custom Wealth Management, Inc. is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Custom Wealth Management, Inc. and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Custom Wealth Management, Inc. unless a client service agreement is in place.